Okay, so I want to give you a quick introduction to bookkeeping. I think it's going to be good for you to know just a little bit of background so you can understand why the accounting software does what it does. So I'm not going to go too deep into the theory behind it all, but I do want to give you a light introduction. So with that being said, so what is bookkeeping? What is the practice of bookkeeping? And the end goal is that you're trying to record every financial event that hits your bank account. So every time that money goes out somewhere, you want to record that, right? And whether that's in a cash transaction or it's a credit transaction, whatever happens, you want to record that event. And we're going to use a specific system called double entry accounting. And that's one of the things that differentiate Xero and software like QuickBooks from other tools that are on the low end of the accounting software market, things like Mint.com or GoDaddy's bookkeeping system. Is this uses a system called double entry, which is actually like 200 or 300 years old, and it was formed as a kind of checks and balances system to make sure that you're always recording everything correctly. And it's based on this idea that we're balancing everything. So there's always an equal and opposite reaction going on with every event. So take, for example, you buy some inventory. When you buy the inventory, the value of your inventory goes up, but since you use cash to buy it, the amount of cash you have in your business goes down. So there's always this give and there's this take. There's this equal and then their opposite reaction. So that's what double entry is all about. It's accounting for every financial event with a balancing entry. And so the purpose behind that is a few things. First, which I think most people associate with bookkeeping, is complying with tax laws. So in order to file your taxes, you have to give an account of your business's performance for tax reasons. And while that is certainly very valuable, believe it or not, people used to do bookkeeping before there was tax codes. So there's a purpose outside of tax, and that's primarily two things. One is to track your performance, to see, well, how well did you do? Did you make money? Did you lose money? Where did your money go? What did you spend your money on? That kind of performance or analytics perspective is one of the major reasons that bookkeeping was even created. And then the other aspect of that, which is I consider like the other side of the coin, is it's to help know your business's net worth. So what are the assets? What are the liabilities? What are the stored up value, which is also called equity? What is your business's net worth? How valuable is your business? And so that's the third major purpose of bookkeeping. And these come together to form kind of the backbone of why bookkeeping was created and why it's used and why people still do it today. I also want to give you kind of the progression of bookkeeping. So in the past, accountants used written ledgers. So they'd have these booklets, and what they would do is they would record these double entries, these cash going out, inventory going up. All of those entries were actually written in a book. And there would be one main ledger that has all of the values in all the different accounts, and then within each of those accounts, like inventory and cash, you would record the money going in and out of each of those accounts. So that's how it used to be done, believe it or not. And for most accountants that still go through school, they have the pleasure of getting to go and set up these written ledgers. And by pleasure, I'm being very sarcastic. It's a huge pain. And you can see why it progressed to the next step, which is when software started to come out, it started to organize that in a database. And what these bookkeepers would do, like with the QuickBooks desktop software back in the 90s and the 2000s even, is accountants would get the paper statements for each of the bank accounts, and it would just one by one enter those transactions into the software. And the reason that they use the statements from the bank account is because if our goal with bookkeeping is that we want to record every transaction that occurs in your business, the bank account is actually a really good gateway to handle all of those transactions. And the reason why is because almost everything that could possibly happen in your business at one point or another, it has to hit your bank account. So if it's cash going out, maybe you grab money out of your bank account, or if, let's say, you use your credit card to buy expenses, well, that money has to go out of the credit card to get that expense. Or when you buy inventory, you use part of your bank balance. So pretty much everything at one point or another touches cash or a credit card. And so these bank statements kind of form the hub of the bookkeeping process of entering all of these statement lines one by one into the software. And being that that was the practice, it just made sense that as software and internet-based technology progressed, that instead of manually entering these statements into software, they now have automated feeds that go into the software. So you have the good fortune of being in a time, an era when it takes businesses as little as it has ever taken them to do their bookkeeping because of the efficiency of bringing in automatic feeds. And not only that, but because it's automatic, the software can start to predict the data that's coming into it and pre-categorize things for you. You're really in a totally different era than businesses were in even 10 years ago, and it's a really exciting time. So with all that being said, that's the background on bookkeeping, that's the purpose behind it, and that's been the progression of how accountants and business owners have done their books probably since the beginning of time.